So the idea is we're expecting where the market is now to trade down to this level, and then a reaction should ensue. Now, your choice as a trader is, if we're here and you think it's going down here, to set up a move to go later higher. You can be a trader from this point here down, or wait till it gets to this level and then try to trade the bounce. Now, let this image burn in, so that way when we transition to the market maker buy model, it's this idea we have in mind here. Okay, market price is here. We're expecting to trade down to a key level and then rally up. Okay, with that idea in mind, usually the market will be in some measure of consolidation. I like to see some kind of a little short-term trading range, and it is very subjective, this part. Okay, what is a trading range or a consolidation? Where price is having several candles, not 2, not 3, not 4, but it just stays in an area over a prolonged period of time. How much time, Michael? It's all relative to the time frame you're looking at. If you're looking at a 15-minute time frame, it could be, I don't know, maybe 10 candles or more. And I'm just giving you a rough idea because experience is going to guide you on how many candles really make up a consolidation. So the market will leave this consolidation, and inside this decline, we wait for another area of either retracement back to the original consolidation, which it does not have to do. Okay, it does not need to do this. This is kind of like what the Wyckoff theory folks will look for. There's lots of times where it just doesn't do that. And that's why I don't teach Wyckoff. That's why what I'm teaching you here is not Wyckoff. So as the market drops down, I allow in my analysis the potential to return back to the original consolidation. But if it does, I need to see a very sharp rejection there. It can't just come back to the original consolidation low and then hang around for a little while. It needs to come back up there and then break. I like it even better if it tries to make an attempt to get back to the original consolidation low, okay, and fail to get there and then breaks hard. I really like that because that indicates a very heavy market and it's likely to continue going lower. But either or, the next short-term consolidation, and this doesn't usually last as long as the original consolidation up here. So what we're looking at is a consolidation, a market that breaks lower, that maybe trades up to here. And if it does, we'll look for a sharp decline. If it doesn't and just goes right into another area of consolidation, it usually will set up like an optimal trade entry. And if you're new to this channel or you're just watching this video for the first time, I have a plethora of videos that teaches my optimal trade entry pattern. It's a very simple little pattern. It repeats every single day. It repeats on every single time frame. You just need to know what you're looking for and why it should be forming there. And this is really the point of this lesson, is where in market structure should things occur and how do we interpret it and how do we anticipate it. So in this area here, usually you're going to see an optimal trade entry short. It'll be a low retracement back up into a bearish order block and then slams lower. Or it could be a low short-term high and then a higher short-term high that runs out short-term buy stops. Then it sells off. So either one of those instances will allow for me to take a trade going short. Because remember, I'm waiting for some level down here I've indicated at the beginning of this discussion that I think it's going to trade down to. Or I'm watching price and I'm not really engaging price. I'm just monitoring it and practicing and reading price. And I anticipate some measure of selling in this area. Or I'm watching price so that way it just keeps me closer to the marketplace. And I'm practicing either with a paper trade or a demo trade, or I'm illustrating something with my teachings and lessons. I'm just anticipating, whether I'm engaging or not, another price leg lower. And when it comes, should it come, we're waiting for some kind of expansion lower. And sometimes we'll get a secondary level of distribution, which will be another either optimal trade entry sell or a short-term high that's ran out with a higher short-term high, and then leads to another level of lower prices until we get into that area where we expect that key level to be reached. This is where the market goes into smart money reversal. Okay, usually it will form the same way it is outlined in the price swing, where it'll create a low, a lower low, and then look for a breaker, or it goes low, higher low, And if it occurs like that, again, using the intermarket relationships I mentioned earlier, if it creates a low with a higher low versus one definitive low that takes out a previous short-term low, in other words, the diagram I outlined when it was just that big blue V giving you a rough depiction of a price swing, the little animations I put in at the low, those are the only two things that can happen. That's it. So how they trade and form in price leads to what process you look for next. I'm not really interested in a market that will give me a dull, flat, blunt-ended low. I'll avoid that. At all costs, I'll avoid that. Because that means I'm going to have to wait, because we could be seeing just another level of distribution that leads to another break lower. And then I'll revisit the analysis at a later time. But if we see price trade higher, we're going to assume that the smart money has accumulated longs in here. They are not pushing price up when they go long, by the way. We're seeing price trade down to this level, and then it kind of like spends a little bit of time down here, not a lot, certainly nowhere near the length of time that the original consolidation looks like. Very short-term little consolidation, and the algorithm keeps price in that range. Okay, so it's a small little dealing range it works in, and then it'll reprice. If smart money traders do not buy, they miss that move. So they'll have to wait for a low-risk buy. And that usually will happen over here in a small little consolidation, which will form in what? In the form of a optimal trade entry buy, or a low, and then a short-term lower low that takes out buy stops and then rallies. Remember I taught in the previous lesson in this series that usually right before significant price advances higher, some little short-term lows taken out for stop raids, and they assume those positions when the stops are taken. Those sell stops flood the market with selling, so that way counterparties that understand what the algorithm is about to do with price sending it higher, they'll buy those sell stops, and they'll be positioned for a rally higher. We would expect price to trade higher until we get to another level of accumulation. So what we've already seen here is consolidating and accumulation of shorts. Accumulate more shorts. Accumulate more shorts. In this area, you may only get one area of distribution, and then it trades down to the smart money reversal, where they distribute their shorts down here. So they're going to buy to sellers at a low price, and everything they assumed over here should be hopefully offloaded here. Some of it here and some of it here. So their heavy positions are entered here. Some of it's taken off in profit here. Some of it's taken off in profit here and here. Or they'll go short here, add more here, and dump it all off here. So there's two ways for them to engage price and work within this market maker buy model. The longs that they assume here, they may not get them all on, and they'll have to add more here and then add more here, because as price is rallying up, it's going to be targeting the original consolidation until it targets the buy stops above this relative equal high or consolidation. All those buy stops will be the target of all of this. So if you're ever looking at price and you think that's going to trade lower to go higher, the original consolidation, aim there. You might have a higher time frame target somewhere beyond that, but initially study all of old price data, price swings, and you'll see this phenomena is occurring. And you don't have to have all of the complications that are introduced with retail concepts. I mean, this might seem too vague, and it may seem an oversimplistic approach to describing something, but I promise if you go into charts and study it, you'll see this very thing unfolding. It happens on all time frames, and it happens on buy and sell. This is a market maker buy model where they're taking price down, not the traders, the algorithm. All the algorithms are working together. It takes price down, then allows traders that know what to anticipate to onboard here. And then they take it in scalings here and here. And then finally, the last bit of a run, it's in a hurry to get above here. Now, conversely, we can look at price doing the opposite, where this is a ICT market maker sell model. we're going to assume that the market price is down here, and we think that the price is going to go up to some key high. Again, that could be running on an old high. It could be trading to an old high and just falling short of it because we don't think it's going to go higher. It could be trading back into an optimal trade entry, sell. There's all kinds of things that would be outlining this as a key level. But what makes it key again is it's a monthly, weekly, or daily level, and at the lowest 4 hour. But again, I'm only throwing the 4 hour out there as just an extra side note because predominantly the levels are going to be key because they're on those top higher time frame, daily, weekly, and monthly. So as the market trades higher and runs into that, you could be a participant in buying that up or studying it as it rallies up into that key level, and then the expectation of lower prices if it materializes. This whole fractal, okay, or price swing, is what we're trying to strip down to its basic components. Okay, what elements occur inside this entire price range? That's what we're highlighting here with the models. The high can form obviously with the higher high and then breaking down, which sets up a potential bearish ICT breaker, which would be over here somewhere. But the high and then higher high forming this high, this is what I like to see. I'm more confident with this pattern. But conversely, if we're looking at it where we have a high and a failed higher high, and then it breaks here, this is only significant in a market structure break if we have intermarket relationship confirmation. Again, let's assume for a moment that this is British pound versus US dollar. And British pound versus US dollar makes a high and a short-term lower high and then breaks down. This is ideally a break in market structure on cable or pound dollar if euro dollar makes a high, low, higher high, and then it breaks down, because that would be a correlated pair SMT divergence, smart money technique or smart money tool. Because what that is indicating is that cable was underlyingly weak from an algorithmic standpoint. It was unable to make a higher high where euro was. And I'm speaking hypothetically, obviously, but that's how I would use this lower high formation. So in other words, if I think it's likely to form a lower high, then my attention will go to a correlated market. Like, again, if this is assuming pound dollar, I'm going to be really watching euro dollar, and I want to see, and if it's occurring here in cable, I want to see and almost demand that it's a higher high in euro. Now, if it creates a higher high in cable and it creates a higher high in euro, that means we might not be really topping yet, and I'll have to wait for more information or a real strong breakdown, and then I can get back in sync and trade with it later on, as you'll see. Just reverse everything I'm saying here for the other one. If you take an optimal trade entry, sell here, and it starts to go down and then runs up and takes you out of the trade, then what you can do is put a sell stop below the short-term low that's formed thus far. And if the market goes down there, it could take you right into the market short. And if it's going to do what we're expecting here, it probably isn't going to do a short-term high that's higher, and then a short-term high that's higher. That's unlikely. Can it happen? Yes. So rare, it's probably never going to happen, but it can. So there's no reason for you to fear being knocked out or kicked out of the marketplace and take a loss, because if your analysis is correct, then you're probably still going to capture some move and overcome that drawdown you've taken here. And if you get this other opportunity over here and you had a stop run here, chances are you're probably not going to get a stop run here. It'll probably just be the optimal trade entry run right from a bearish order block down. And it usually will be aggressive and quick to get down to the low of the original consolidation where sell stops are resting. So this is the elements to a market maker sell model. Let's assume that we're looking at this level over here. It's a daily chart. It's relative equal lows. So you know what's resting below that, sell stops. And we're trading right here. So we're looking at this high, the low, and we retraced in, and we look like we're about to break lower. We have relative equal lows in here, so there's sell stops there. Lots of sell stops there. So we would expect to see price trade down there. So this is a key level. Ultimately, price does cascade lower. The market has now, at this point, traded sell stops, accumulated longs, and then we have these relative equal highs. Okay, in the last lesson in this series, I talked about how this is the next draw on liquidity, and the market trades up into that on Thursday of the week of this production, and today's Friday. So the market trades up, and we've completed a accumulation of sell stops and a distribution to buy stops. Smart money buys sell stops and sells to buy stops. Okay, so we can use all of this information here for the weekly range to get to our objective on weekly pip objectives. Let's assume this is that area where we were looking for the buy stops, and this is where the old low was on the daily chart where the sell stops were. Look what we have here. The market's consolidating. It leaves the consolidation, but why doesn't it come back up here? It doesn't need to. So it's better for it not to do that. And we have what? We have the level of distribution here, because we have what? Optimal trade entry, sells off. Another level here, optimal trade entry, sells off. Trades below that old relative equal low on the daily chart. That's that blue level on the daily chart. There's equal lows. Those sell stops are being absorbed here. The algorithm holds price in this little consolidation, allowing smart money to accumulate. Their buying does not send price up. But in this instance here, the market's consolidating, allowing smart money to accumulate longs. Once it takes off here, they can't enter. They've already missed that opportunity, so they're going to have to wait for some new level of accumulation. We have a low, a high, optimal trade entry in here, rallies up. We have another level here. From this low to this low, that's optimal trade entry, because you have a high, low, higher low. Boom. Rally. Trades up, consolidates, rallies again, and then drops down, takes out that short-term low. We talked about this in the previous discussion, or volume. And then it accumulates and goes higher. The algorithm is driving price up here. It's not the buyers. Okay, it's not the buyers. The question is this. If it was just the buying pressure, why didn't it run from here all the way up to breakout above here? Because that's where we were aiming for. Why didn't it run from here right above here in one shot? Why is it doing all this consolidation? I mean, think about it. If the buyers are really controlling price, and then retail traders come in behind and they buy it later, chasing price, why doesn't all that translate into just singular price runs where it just goes in one shot? Because that's not how the markets book. Okay, it's not how it works, folks. All of these lows here are critical, as we'll talk about in later discussions that are outside this video. But nonetheless, we're looking at how price trades down into levels that take out short-term lows. Short-term lows are taken here, it rallies. Short-term low was here, it took it out, and then it rallies. Short-term low here, trades down below it, and then on FOMC right there, it wipes it out one more time and then rallies. Then it takes out this level here, which will be critical later in other videos in this series. And ultimately takes out all the buy stops above this relative equal high and or original consolidation. So this is a market maker buy model. Now, we're going to talk about SMT, smart money tool or smart money technique. When we are down below these relative equal lows on British pound, we're expecting price to accumulate those sell stops. But how do we know that that's really going on? How can we trust that? Well, bring in the dollar. The Dixie, DXY, is being overlaid on the pound dollar chart. And on TradingView, you can see that the dollar index went a little bit higher than this short-term high there. At the same time, pound dollar was unable to go lower than its previous low. Now think, if the dollar is going higher, pound should be going lower. But if pound is going higher, dollar should be going lower, vice versa. But if you look for times when there should be a key level influencing price, This is when you go to SMT. Now, I taught SMT on baby pips like 10 years ago, and everybody took that and ran with it and tried to make SMT occur on all time frames. Every time they wanted to get a trade, they're looking for it. You only consider using SMT, which is a divergence between correlated or inversely correlated markets. If you're looking at the dollar index against the pound, or if you're looking at the dollar index versus the euro, or the dollar index versus the Australian, okay, that's a USDX SMT divergence, or dollar SMT. If you're looking at correlated pairs that are like euro and cable, or like, let's say it this way, euro dollar comparing its lows to pound dollar, that is a correlated pair SMT divergence if you see them break their correlation. In other words, this is a breaking correlation. This high with a higher high on dollar should have been seen with a low and a lower low on cable. But notice what's happening. This right here is how the algorithm tips off the traders that are in the know. We already know going below those relative equal lows that their sell stop center is probably going to go down there, accumulate, and go higher. That's likely. But how do we really know and trust that's going to happen? The dollar index gives us the insight, the x-ray view, if you will, where it went high, higher high, low, failed, lower low. So it's telling the traders without really broadcasting it that, okay, cable's going to start going higher because it failed to make that lower low where the dollar made a higher high. So this is SMT divergence. Higher high, higher low. This is occurring at the same time we're below those daily equal lows, and we're expecting price to go higher anyway, and all this does is confirm. SMT is not a timing tool, it's a confirmation tool. Okay, it confirms something that you were already expecting anyway. And this is why a lot of folks that learned from me on baby pips thought that, oh, SMT doesn't work. It doesn't work because I tried to look for it here and there, and it failed here, it failed there. You don't go into your charts looking for divergence between highs and lows. That's not what you're doing. You have to have logic and some measure of a narrative behind what it is that you're looking for. Otherwise, the divergence could be there momentarily and then completely evaporate. And then what did you trade on? You traded on the basis of like an indicator. And this is not an indicator when it's done correctly, because I'm comparing the price of one benchmark currency, the dollar, versus another currency pair, and they should be mirroring one another. Okay? So if this is higher high, this should be lower low. If it doesn't do that, that to me indicates as a crack in correlation. Therefore, it's tipping off algorithmically. This is the signal it sends. It's not, oh, it went down and there was not enough sellers to send it lower. That's not what that is. It also isn't a low and there's too many buyers to let it go down. It's not that either. I'm telling you what it is. I'm telling you exactly what it is. And majority of you aren't going to agree with it because you know, you probably read 14 books, okay, or watched a couple videos on somebody else's YouTube channel, and they swear up and down that it's this and it's that, and they maybe have exotic cars that they're leasing, and they're trying to convince you with stacks of money they're carrying around with them all the time and going on trips. Go into a chart, okay, and use these things I'm teaching you, okay, and study like that. And you'll learn far more than any book out there is going to give you. Because most of the books that's being written now are just bleeding information from what I'm giving you here on this YouTube channel or from my mentorship. And that's the truth. And if it sounds arrogant, I'm sorry if it sounds arrogant. I'm not trying to be arrogant. I'm just telling you, if you're going to learn how to do this, you need to learn it from the source. And that's me. I'm going to show you how to use this stuff and make money with it. Real money, not demo dollars that I teach for compliance reasons, because I'm not licensed to give you trade advice. But I promise you this, if you learn this stuff and you get good with a demo account, what separates the ability for you to do the same thing in a demo account and a live account?